I should say that everything that Edward de Bono has just said could obviously easily be applied to the boardroom, where you certainly need to have more challenge, more provocation and more creative thinking. And one of the difficulties with the subject I'm going to talk about, corporate governance, is that regulation really only does get you so far, because it's obviously about human behaviour. But the other thing is about corporate governance is that there's been so many regulation. There's regulation, there's another scandal, there's more regulation, there's another scandal, there's more regulation, that a lot of people complain that it's become very compliance-driven and process-driven, and people are constantly worrying about how they're doing it instead of what they're doing. And obviously, for people, I'm very interested in corporate governance, but I also love business, and the whole point of the exercise is to create wealth, to foster investment, to help markets to work better, to oil that link between capital providers and the companies that they invest in that create wealth. So the point is that corporate governance gives the investors confidence that the company is being run in their interest. We'll come on to an example of principal agent issue in a minute, but they are the principals, they are providing the capital, the managers of the company are their agents, and there's just this perennial age-old problem: how do you get the agents always to act in the interest of the people who own the company? It's easy in a founder-owner managed company because it's just one person. As soon as you get beyond that, it gets more difficult. The investors obviously want value to be created via the company's cash flows. Clearly, with a startup, you don't have cash flows straight away, but you'll be looking ahead to cash flows in the future. And we're seeing today the amazing flotation of Facebook, and the only way you can arrive at a valuation of $100 billion for something whose sales at the moment is between $3 and $4 billion is by making absolutely heroic assumptions about future cash flows, future profit margins, low discount rates, assuming all this won't be very risky, and so on. But that's what's happening with Facebook today. People are putting a value on their hopes for Facebook's future cash flows. The investor obviously assumes the company will manage risk. Facebook, you hope that in eventually monetizing all the information that they have about people, that they won't annoy, to put it politely, their customers so much by messing with their privacy and driving them away in that way. And of course, you want the company to operate within the law and other regulation. That's partly because you think probably most of the laws and regulations are okay. You may not agree with all of them, but you're also worried about the company's reputation and its permission to operate in the jurisdictions that pass those laws, whatever you think about them. And this has to be transparent. You need the financial information so that you can check that the cash flows are developing the way you expect, from the sales down to the earnings, and also in terms of the balance sheet. Why is the debt going up? Can I see why that's happening? And of course, non-financial reporting as well, which is getting increasingly onerous, which looks at some of the other risks, such as environmental and so on. And the way to put this really is accountability. Shareholders, the managers have to be accountable to the owners via governance. So the shareholders must be consulted on the biggest deals. They're now, of course, increasingly being consulted on pay for their agents. And if they don't like any of that, they can ultimately kick out the management and appoint new ones. But we've had that. I think governance should be fairly simple. I think it is to do with creating wealth. I don't think that means that you ignore other things. We had an eminent trade unionist speaking earlier. A company is not going to create wealth for shareholders by sending children up chimneys or making its workers ill. Or there was a scandal in China with one company which had a lot of people committing suicide. That doesn't actually create wealth if you treat your employees badly. Of course, you have to be efficient, and you've got to get the balance right between the two. But nevertheless, I think it's still easiest to put this in the sense of reporting for equity investors. And if you look at some bodies, such as the IFRS Foundation, and I know rather a lot about accounting, which I won't bore you with at the moment, but the IFRS Foundation, which oversees the International Accounting Standards Board, looked at other public policy directives just at the end of the last year, such as prudential regulation, anti-corruption, and they decided that the best way was to maintain the purpose of financial reporting as being for the providers of capital, but to provide transparency and to have dialogue with other interested parties, such as prudential regulators, that was the way to go, rather than having diluting the purpose of the accounts in the first place. Of course, you should have a broader view of capital providers than just shareholders, but actually because the shareholders bear the most risk, because they're at the end of the queue in an insolvency and they provide the loss-absorbing capital, if you provide enough information to satisfy the people who are taking the biggest risk, you will satisfy most other people along the way. And then, as I said, you've got these sort of increasing pressure for reporting, at least, on environmental and social factors. And, of course, companies are operating in whatever they do, it's increasingly public, and what other people are saying about them is increasingly being broadcast via blogs, Twitter, Facebook. Somebody said they were going to be tweeting about what I'm saying today, so otherwise I'd have said much more scandalous things, but now I know I'm being broadcast. I will be very quick on this. I am a historian, and history does not start in 1600. I'm sure the ancient Greeks, Babylonians had forms of corporate activity, but the interesting thing about the Royal Charter granted to the East India Company, which is perhaps a sort of company a bit that we'd recognise, is that it had a court of owners and a court of directors. So you see that capital providers and their agents, you see that happening. And then over the next 400 years it's developed. Limited liability of shareholders. Actually, in the wake of the crisis, some people have said perhaps that was where it all went wrong, that where you just said that shareholders can only lose the money they've put up, that the creditors can't pursue them for their property and for everything else. Maybe that was the beginning of moral hazard and therefore the beginning of the end. But nevertheless, if you hadn't had that limitation, there would have been a massive amount of wealth creation foregone. We all know that the last very big crisis in the 1930s, following the stock market crash of 29, led to the last great re-regulation, creation of the SEC and so on. And this idea of, but again, the principle is that you have to protect investors and maintain fair and efficient markets. And then we have corporate governance developing, as I said, in a response to a series of collapses. Penn Central in 1970, lots of them in the UK in early 90s, which led to the Cadbury report, published 20 years ago, which was one of the, most of you will remember as the first in the sort of modern sequence of corporate governance reports. And it said a number of very important things like separating the role of chairman and chief executive. 20 years on, the US hasn't quite caught up with that one yet. I hope that Malta has. It started the ideas of more specialist board committees for nominations, audit and so on. And it actually also started to formalise the sort of shareholders' role in terms of being stewards and questioning the company. And it had this quaint idea of comply or explain, saying that because this is a behavioural issue, you shouldn't have one size fits all. So if you've got a very good reason for not obeying the rule, so long as you explain why, shareholders can take it or leave it. And if they don't like it, they'll sell your shares. And if they do, they'll accept the explanation. Of course, pre-crisis, interestingly, financial services was not the focus. A simple view of this is that there was the great re-regulation of the 1930s, which lasted for at least 40 years. It was really from 1970 you started to have quite a lot of deregulation, particularly then accelerating in the 80s. But actually, that round of re-regulation in the 1930s served the financial services sector pretty well, and it was other sectors that were throwing up the scandals. Even when the dot-com bubble burst, There were other scandals in 2000. It was Enron, not a financial services company, although arguably what they were turning themselves into looked rather like a financial services company. It was asset light, it was a heavy user of derivatives and so on. But it was ostensibly a power company. Parmalat was supposed to be a dairy company, although actually its last annual report doesn't mention dairy very much because it was all to do with the corrupt founder of the company maintaining control. And of course there's been a focus on remuneration for a very long time, usually with perverse consequences. So Clinton says the company can't deduct pay beyond $1 million. Companies start paying people in share options, and you have a ridiculous scandal of people being paid via share options, which were never valued properly and ended up delivering a huge amount of wealth to the people who ran the company and actually not that much to the shareholders.